Hey guys, thought I'd do a bit of a sort of more beginner video for the newer investors. Sort of been mentioned a few times. What I sort of look for and what I think has sort of moved stock prices in general. So the sort of more experienced of you may not find this all that useful, but yeah, see what you think. So yeah, kind of going through various sort of aspects that would move the stock market in general or sort of individual stock prices as well. So this is Sven Carlin's sort of discounted cash flow spreadsheet that he allows you to download for free very kindly. And I've just brought up Facebook's one that he's done for an example. So this is about a year and a half old actually, because I haven't downloaded it recently. So it's quite interesting to sort of see what he sort of put in as his sort of rough figures back then. So he came to a $919 billion market cap for Facebook, sort of based on various assumptions, cash flow, sort of growing from sort of 2020 through 2021 and onwards, sort of 15% growth rate on the earnings for the next 5 years, and sort of 10% after that, and discount rate being sort of 10%, essentially sort of what you're hoping to earn on your investment per year, and then willing to pay 30 times earnings at the end of the 10 years. So that's what he came to back then. Obviously, since then, we are a fair bit down. So could be a various few things that would have caused that. So first one possibly being the Federal Reserve interest rates. Obviously, sort of a year and a half ago, we were in the middle of the bad times, sort of 0% interest rates pretty much, and we've since had sort of high inflation, and the Fed sort of looking into raising interest rates quite a lot. So this is sort of the fairly recent 16th of March, the dot plot, as they call it. So this is sort of where all of the members of the FOMC committee sort of see interest rates being over the course of each year. So you can see sort of for this year, they're saying an average of nearly 2%, 1.75% maybe. Yeah, so that's probably sort of towards the end of the year. Next year, they're sort of looking at 2.5 to 3%. So they're sort of projecting quite a few interest rate rises this year, and then a few next year, and sort of normalising around 2.5 to 3%. So this would sort of do quite a few things. If people are sort of getting decent money now on bonds as opposed to sort of 0%, bonds, sort of Fed 10-year treasuries, I think nearly are sort of 2.5% already. If they continue up, then people might start to want a bit more than 10% on stocks. So you may sort of think, if I'm going to take the risk on stocks rather than just sort of hold bonds or even money in a savings account, if they start going up with the interest rate rises, then maybe you say I want 12% a year from stocks. So that would sort of bring down all the future earnings. You're discounting that back at 12% now instead of 10%. So you're saying the future earnings are worth less. And yeah, so that would bring you already down to sort of 768 billion for Facebook from sort of 900 odd. And then, as I say, part of the reason for the interest rate rises is inflation. So this is the UK CPI inflation. Most sort of major economies are quite similar. So on the sort of 5-year plot, we sort of got down to very low, obviously, in when everything was shut down. and since then we've printed an awful lot of money. Some of this has been sort of attributed to the war, which I don't think is quite right. We were sort of over 6% before the war, so it is, in my opinion, largely down to the money printing. So with inflation, obviously, comes higher costs, sort of higher. Facebook would maybe be shielded from some of this because they don't exactly buy a great deal of things that are going up, sort of commodities and various things. They do build out a lot of sort of data centers and that sort of thing, so they'll be buying semiconductors and sort of obviously having to pay for facilities, so that would affect them. But yeah, inflation sort of going up means earnings may drop, and sort of part of the reason people may be less willing to pay, say, 30 times earnings in the future. So yeah, you could get a sort of combination of maybe earnings and cash flow drops a little because of the increased costs, labour costs, and sort of various material commodity costs and that sort of thing. And on the other side, people may be less willing to pay sort of 30 times earnings. So you could get, say, a drop to 25 times earnings people are willing to pay. So that brings you down to 640 billion from 900 odd. And then, so that's the sort of part of the macroeconomic news. Obviously, you'll get lots and lots of sort of various macroeconomic news coming out. Sort of unemployment rate would affect things. Various sort of economic indicators. You get the sort of PMI, industrial indicators and that sort of thing. Maybe that would affect tech stocks like Facebook a bit less, but yeah, there's all sorts of sort of macroeconomic news that would come out during the weeks and months that would sort of maybe affect discount rates and sort of PEs that people are willing to pay. But then you also have company-specific news. So Facebook had a bit of an issue over the last sort of couple of quarters, really. This has been in the news. So Apple sort of not very happy with Facebook having quite a wide reach on people's phones and data, and they've sort of introduced some transparency sort of restrictions or tracking restrictions. So Facebook now aren't able to sort of track people quite as much on their phones, and sort of the revenue advertising potential has come down. So this caused a drop. So they're saying it would result in 10 billion revenue hit this year, and people sort of take those projections down. So 90 days ago, people were projecting a $14 earnings per share, $14.20 earnings per share for Facebook, sort of based on previous earnings and sort of what they see as upcoming. Previous, so this is the last year of earnings for Facebook, or that was the estimate, and then that's the actual earnings. So you can see sort of March last year, they had quite a nice positive surprise. June, it was a bit less so. September, they were pretty much bang on the money. And then the Christmas earnings were a bit worse than expected. And then this has sort of now come in. And so next year, with them being fairly bullish previously, that's now come down to $12.62. And sort of since then, even down a fair bit. And next year came down from $17 to $14.92, and then sort of down a little bit more. So you may sort of, people will be coming back to their discounted cash flow models and sort of adjusting future earnings maybe. So 2021, that isn't obviously what they earned, but it was sort of a model, so you would update it with actual earnings. But if the 2022 projected sort of cash flow was, say, $35 billion, you may sort of see this news and sort of project the institutional analysts may look at it and project, say, a $30 billion cash flow sort of growing at the same rates going forward. Or they may even drop the rates a little. But if we say kept the same sort of growth rates and the same terminal multiple, that sort of coincidentally comes to 537 billion. So obviously this is a very, very basic analysis, but that sort of brings you down to, say, $570 billion. So yeah, if you look on the 1 year chart, this large drop was sort of coming out around that time of announcing the Apple news and the sort of loss in projected earnings. And yeah, the part of the rest of the news may have, or part of the rest of the drop may have been more down to macro news, as the earnings projections were sort of rising sort of throughout this time. So you get sort of a drop in the market overall, and then sort of a drop in the stock itself due to sort of stock specific news. So yeah, just thought I would sort of go over a few aspects that can affect sort of the market and particular stocks in general. So you may sort of see something like the interest rates or inflation. It'll sort of hit, all of tech stocks, basically, all your Apples and Googles and them sort of companies might get all hit 3 to 5%. That would probably be more of a macroeconomic sort of news update or development, and you might get sort of a large sort of drop like this when maybe the other tech stocks are sort of fairly flat, or maybe down a couple of percent, maybe up even, and this will cause sort of a large drop in this stock itself. So yeah, you can normally sort of, with big stocks like this, you can normally find the news generally on places like Yahoo within sort of a day or so. Smaller stocks, you probably have to dig a little bit deeper, or you may not even find it. It may be sort of something more behind closed doors that the institutions will know about. But with big stocks like this, you've got 54 different analysts covering this coming year's earnings, 51 for next year. So yeah, there's just a little bit more eyes on companies like Facebook. So yeah, just a beginner's sort of overview, if you like. Yeah, maybe update this and sort of do a little bit more later on. So leave your thoughts in comments below, and like and subscribe. See you soon.